Joining. Can you hear me in the back all right? Okay, great. Welcome to the final session of the technology pre-conference track. I think we're saving the best for the last. So we have two great speakers for you today who have a wealth of knowledge and are going to be discussing how advisors can reach the next generation of investors, Joel and Blaine here. They'll also be at the Morningstar booth when the opening reception kicks off at 6 p.m. So if you have any questions and want to pick their brains about technology, feel free to stop by. Recognized as an industry leader in financial services, business development, and technology, Blaine Warren has held progressive roles in operations, technology, and compliance in the industry. He co-founded Arcovi, social media archiving, in 2009, which he sold to Reg Ed in 2012. Warren continues to advise companies via QuonWarrene. In addition, he is a sought-after speaker and panelist at industry and corporate conferences, hence he's here. Where he brings a fresh and an innovative approach to business issues. An avid podcaster and well-known on Twitter, Warren focuses on the effective use of technology for financial advisors and institutions. He serves as a board member for the Denison Railroad Depot Museum, an Ohio National Historic Landmark. All right, Blaine?
Absolutely. Well, thanks everybody for joining us today. And I'm going to stand up and pace. I think Joel's going to do the same. It's a little bit easier to tell this story and talk to you. If I look a little bit about like Joe Cocker, it's because we're kind of blinded by the lights up here. So if I look at you kind of funny, it's not the coffee, it's the lights. We want to talk about a couple of important topics today. There's a lot of ground to cover, but we're going to try to hit on the indicators or the topics that are really impacting you, your clients, or your future clients. And mobile is one of those areas that's really changing the whole field, from what we do every day personally at home and outside of our offices, how we work in our offices, how we are all working here remotely, right? iPads, iPhones, smartphones, everything in our laps. A lot of us can run our business from here, including the tools we need to serve our clients. So there's a lot going on, but the flip side of this is also there's a couple of things to pay attention to. One is that folks that want to or will do business with you are going to anticipate coming to you on those same mobile devices. And we need to think about what that means for our business. And also the security factor. I talked to someone walking in who said, yeah, you know, someone has been talking about this, calls it the dark cloud, right? It's that 800-pound gorilla in the room that we don't quite know how to deal with. Just like the retirement story with the 800-pound gorilla, right? There's a lot of unwieldy things to deal with mobile security. So we're not going to scare everybody today, but we're going to hit on that as a very important component of what we're doing. My name's Blaine Warren. I don't need to introduce myself any more than Kartik did. But my background is in the industry. I started as a tech and a system administrator back in the early 90s in the industry, and in essence shifted to the business side of technology in the broker-dealer and the RIA space. And then Neil Kwan, who's in the audience here today, is my co-founder at QuonWarrene. And we met when we worked in the industry together and ultimately launched this business to serve institutions and advisors. Just a real-world example, how many are tweeting on the hashtag? MICUS. If you're unfamiliar with it, you don't have to raise your hand, but just a real-world example of mobility, right? We're all here at the conference. You can open up your Twitter app. It looks pretty much the same on any smart device. And there's a little search wheel on the top. You can type in #MICUS and hit search, and you can see everything that everybody's talking about on that hashtag at the conference. That's something that people that aren't here are doing, that are aware of it and trying to get a sense for what's happening at this event, what people are talking about. It's important to do it while you're here. You can learn a lot from your peers, your competitors, your friends, and get into the conversation. And as Kartik mentioned, the Morningstar booth and the Social Media Center are here to be a resource to you, especially on mobile technology on that front. A lot's happening that's impacting mobile. It's really, if you break it down into areas, there's content, right? How we show up online and how people visit us and consume information about us online. There's the devices themselves and how we do business with our technology providers. There's how we interact with our clients. what technology we use to interact with them when we're not sitting in front of them at the table, and also what that means next, right? What's next? The big question we always ask ourselves. I used to pride myself in doing research where I said I could look out 5 years. I don't believe that I can look out 5 years anymore, and I play with this stuff every single day. That arc is getting shorter and shorter, so you have to keep your ear to the ground on what indicators are happening. And it's very critical to think about how the workplace is going to change. Even simple things like the Apple Watch. I've seen some Apple Watches floating around already at this event. Neil has one on his wrist, and he's playing with one at this event to see, is there anything useful to use this for? Because are our clients going to walk in with it and say, hey, we're using this for X, Y, and Z? We have to think about the mobility that may impact us even before we're willing to adopt it. A very important component. There will be a theme you hear in that when you hear Joel talk about big data and some of the topics that he's going to cover. These are things that we may not be in a position to adopt today, but we have to be sensitive and aware of them because we're going to be presented with them from our clients, especially as the generational shift happens with our clients. There's a lot of expectations we may not be ready for. In a nutshell, what's happening with mobility to us in the industry is it made cybersecurity bubble to the top, right? You can't trip over something without hearing about cybersecurity now. If you rewind 3 years, we could replace that word with social media, right? In our industry, that was the topic that you heard about every single day. You still hear about it, but it's becoming more of our muscle memory and how we work day in and day out. We're very comfortable with communicating over social channels, but it's very foreign and oftentimes, and I'll admit myself, very frustrating to apply a good, strong, smart cybersecurity policy on mobile devices because they suddenly become a little inconvenient again. So that's something to think about and adjust to. CRM is a hub, right? Our business is powered off of CRM. I have an old CIO I used to work for, he called it the source of truth. He was very biblical in his analogies, and that was the source of truth in our business. If it wasn't in CRM, it didn't exist. And when someone got information into the business, not in CRM, he said it still didn't exist until it was in CRM. And that's was a good culture to create a very effective way to use CRM. Fast forward that to now that you can get to your CRM while you're here at the conference, on your smartphone, on your tablet. Think about what you either are or are not getting into your CRM through your mobile devices while you're here, because what notoriously happens is I go back from the event with a big stack of cards and a bunch of information, and I go back and my inbox is full, my mailbox is full, my calendar is full for everything that I pushed because I was gone all week. When do I get to entering that information into the system, right? It lags, or I have to staff it out or do other things. The tools we have today with the CRMs that we all use in this industry that are very vertically focused on us now give us capabilities to get that data in right away. So it's important to think about that from a mobile perspective as a business owner, as a business manager. How can we make sure it's robust? Because this is ultimately powering the other systems you use, right? We talk about integrations all the time and how they are very, very effective for us, and they can do so much for our business and our productivity and efficiency. For those to work well, things have to be current and accurate and ready. And when we think about dashboards, the way we're presenting information, how quickly they need to update, how quickly we expect them to update for our clients, that mobility is really a powerful factor. So think about CRM when you think about the small screen as well. Accessing data from anywhere, that defines itself, but it's critical to know that both from a good side of thinking, you can get to just about anything you want from your mobile device, but you also have to apply your cybersecurity thinking to that. What am I going to allow to push out to my smart device, and how am I going to manage and control that? It's important to think through those steps as you're either evaluating or looking at your technology. And I'd be remiss not to mention that digital marketing has changed for all of us. Even the Social Media Center here at Morningstar started 5 years ago as a fledgling effort to talk about social media for this conference. And most of the questions were, what is this? Am I allowed to do it in this industry, right? They were the ABCs. It was how we started on social media in this business. But now people come up and say, can I automate all of this, integrate it with CRM? How do I control multiple social networks? How do I report? The questions get sophisticated when we become familiar and comfortable with the technology. So we have to think about mobility now. Most of the recipients, if you study your analytics on your website, on your email marketing campaigns, and especially on social, more than 50% of the recipients, other than your website, are looking at it on their iPhone or their Android phone or their tablet, which changes how you create and share content and distribute content. Not only marketing content, but also think about the dashboard, the reporting. You don't want to push data out to a client, they have to use Internet Explorer, they have to install a couple of widgets, and they have to disable their antivirus. You remember those days? Anybody remember those fun days? It needs to be, I'm on my iPhone, I got your report, thanks. It needs to be very simple and very easy, and there's plenty of brain power in that exhibit hall to talk to people that know how to make that happen. So it's very important to think about those things. Very quickly on security, I would just mention it's as much about behavior as it is about firewalls, software, and hardware. You could have the greatest security in place, but if people don't follow the policy, people don't follow the procedures or practice good habits, that's where you get into trouble. That's how Target was compromised, was by a contractor who had lax security on their laptop. Someone figured out where they ate lunch every day and worked on their laptop for a while until they got on it. They took it back, plugged it into Target. Suddenly 70 million credit cards are compromised, including mine. In fact, I'm getting tired of getting told that I need a new credit card. I've had 5 of them replaced, the same card 5 times, between Home Depot, Lowe's, JP Morgan, and Target. So it gets old, right? It goes to show that we need to be prepared for this. The federal government news from last week was, incredibly eye-opening that, what should be the most secure network in the world was easily compromised due to a lack of procedure and standard. So it's very important, all the way down to our small level. We are now all targets. I'm a target, especially because I talk about cybersecurity, so it's like painting a bullseye on my back anytime I walk out of a room. If anybody wants to hack somebody, well, let's try to hack the guy that talks about cybersecurity. So it's really critical to just pretend like you're Home Depot or Target or Chase and say, what do I need to do to secure what's on my phone? If you think about it for a few minutes, you realize how much important personal information is on your phone, not only yours, but your clients' in your inbox, text messages, all the syncing that happens, the location data. There's a ton of information there to eventually wheedle their way into your clients' accounts. There's a lot of systems in place to prevent it, but you don't want to give them the open door to work on that. On the security side, and I apologize, I caught how small that font is when we tested this earlier, but you'll have access to this presentation. It's really critical. There's 5 steps. Password protect your phone, secure your phone to turn it on, use whatever security is available in a mobile security suite. There are a couple of vendors out there that do this all the way down to the individual or small business level, like Symantec and Trend Micro and Lookout and a number of other firms that have suites for the rest of us that give us the robustness that like Morningstar or a large organization has access to secure mobile devices. We can now get that same level of security. Don't forget about how you sync to your computers. A lot of people like to plug into their computers for personal things with their business phone, right? To get something in iTunes, to get something in some other player or media resource. If everything's secured in your sync and then you plug it into your computer and it's unencrypted, that again is a loophole, especially for those of you that use iOS devices, iPads, and iPhones. You can actually check the box to encrypt your backups in iTunes, and that's an important tip to use if you're using a device for both personal and business together. A couple of quick tips on the CRM side is integrations. Think about the integrations that you need to be mobile, right? You can do everything from work with your CRM, record an audio note and insert it into notes. You can do all kinds of neat things with CRM, but you can also push that CRM data to tools that handle forms, that handle financial plans, that handle reporting. Think about your technology solution like Microsoft Office, right? You couldn't imagine going out and buying from 4 companies to get a word processor, a spreadsheet, an email client, and a presentation tool. It's just click, I bought it, this is all I need. I don't need anything else. Think about that conceptually when you're trying to put together a suite of tools that work for your business. And think about things like mobile, like security, like integration, to paint a really good picture of what tools you need to have to deliver what you want to deliver to your clients. Again, thinking from the perspective of they're going to be coming to you at the small screen first and only drive them to the desktop if they need to have that capability. Some important things for you from a marketing perspective. Anybody see the news in April about Google and websites? Show of hands. Google is now penalizing after April 21st websites that are not mobile. So if you go to the Google engine and there is a URL, you can Google, can I test my site for Google? It's one of the first two results. And it allows you to see if your site is responsive. This is important from a mobile perspective because if your site's ready, you don't have anything to do. If it's not, you have some steps to do because they'll start discounting your standing in the search engines. Now, the other search engines, Bing and Yahoo, haven't said anything about this, but you can assume they're going to follow suit. So if it's important for you to show up and be visible online on the marketing side of your operations, it's important to remember the percentage of mobile users out there is spanning 50% of all traffic is mobile when they generalize it across consumers and business, and it's only climbing. This is a great stat I picked up. This is a great site, by the way, Statista. If you're ever looking for economics charts, there's some great stuff on here that's interesting. It's like first level information about technology and financial services. Look at the 2015 number. They're already talking about that surpassing 35%, that all traffic, period, on the web. So we're pretty soon going to be over 50% in no time at all, where everything will be viewed on a mobile device. Key reminders is be responsive. Go to your providers and ask them to make sure that you can be responsive. And also make sure that when you think about how you share information, think about what it takes to do it with the touch of the finger versus the click of the mouse. You can get pretty complex when you know someone's on a keyboard and mouse. You can have them navigate to very sophisticated levels to get to information. But when you're talking about a touch screen, you all know and have probably been annoyed by those sites where you go and you're trying to tap on the menu to get the menu to drop down and it keeps going to the link on the top because it's not responsive, right? It gets hard to navigate and do things. Very important to think about that. And from a procedures perspective, and I'm jumping ahead here, on the procedures side of your business, we just talked about cybersecurity. We talked about how the traffic is changing and how they visit you. And we're talking about the technology that you need to use to run your business and also promote your business. There's a lot to think about when you have what we call a movable feast, right? Or a portable business, meaning you can run it from anywhere. It's really critical to think through how your procedures might change, how you work differently, how you handle disaster recovery and business continuity. Those are questions that examiners ask you. We don't like to visit those, but they're important questions we have to be prepared for. The bonus is when you put things in place right, you can have part of your business continuity is the fact that you can get to just about everything on that small screen. And that is a fallback measure included with the other steps in your procedures. It's really important to think about compliance first. You know, your phone and your text. How are you capturing information there? If you're allowing these devices to be used in your business, then how do you manage them? And how do you make sure that you're following all of the guidelines you need to, either from a regulatory perspective or your own preference and policies? You need to think about how you're going to interact with your clients and where that data gets. One of the big weaknesses we work on a lot is put a great security protocol in place, including the tablets, but someone's remote and they get the piece of data on their tablet and they go, oh, you know what, I could just throw this into the Pages app on the iPad. That's really convenient and I can get the work done. And suddenly it's stored and synced to iCloud in an unsecure way. And that's fine if it's a marketing document, but it's not if it's client information. So think about those variables that you know you can control. It's very important because that's where the loopholes come in. That's how you get prepared. And as a closer on this, you know, a real concern for us is We've done a lot of research on this in the past 12 months, especially thinking about business continuity and disaster recovery with how mobile is changing how we work. So just like backing up our computers and our servers, right? It's kind of one of those things we say, yeah, it's happening. It's just one of those things that just happens. But it's really critical to think about, because when we did a study, we did an active study with folks that disclosed their names to us, and then we did a blind study to see if we could get a little bit more feedback from people. And you can see that, you know, there's 92% coverage of mobile devices. 23% have tested actually recovering from a disaster. That's a frightening prospect. We need to at least think about what disasters could happen and write out the procedures we're going to follow to recover from them, right? I've lost a phone, I've lost data, I've lost this device, I've lost connectivity, someone's stolen things from us, devices. We need to think through those variables. We don't have to think of everything, but we have to think through a lot of the common things to make sure that you, in essence, you're reverse engineering the disaster so you can create your policies that enable you to maximize your use of all of these powerful mobile tools, which we all use heavily. I do as well. I cracked a joke with one of our team this morning that, you know, my age bracket, I'm tilting towards 50, so I came out of the analog world, but I really embraced the digital world. But even though everybody has iPhones, and I do as well, I love the BlackBerry. I wish I could go backwards, because I love the keyboard. I could type 40 words a minute on that thing. I mean, I could write blog posts on that thing. I was really good at it. And they're dying away, you know, and I want to go in reverse, because that's an easy policy to manage. But it's not a very fun phone for the next generation of employees. And so we have to think about these things that are harder to recover from to make use of all this great capabilities that really leapfrogs us into the next generation of investors, which you're going to be hearing about here shortly. And with that, I don't know if you want to do questions now or you want to let Joel go and then we can do questions after.
Questions? All right. The mic there is not for karaoke, by the way, so towards the end, if you have any questions, Heather will be more than happy to.
If you do want to do karaoke, though, you can jump up and.
Sure. So our next speaker is Joel Bruckenstein. Joel is an internationally recognized expert on applied technology for financial professionals and the publisher of Technology Tools for Today. He is also the producer of the annual Technology Tools for Today conference, the premier technology conference for independent financial advisors. So for those of you who are not aware of this conference, I highly recommend it. I've been going there 6 or 7 years.
Thanks.
Any technology decisions you need to make, it's a great place to check out his conference.
And it's probably not in the bio. I used to write about technology for Morningstar Advisor. So we're going to talk a little bit about robo and big data and really how to help you grow your business. And I've put a lot of information in these slides. I'm not sure we can get to it all, but we'll make them available to you. I just want to hit on some highlights. But one thing that always strikes me about advisors is, and advisors with technology, the more things change, the more things stay the same. So there's a resistance to change within the industry. Advisors are usually not the quickest adopters of new technology. There are exceptions, like the iPad, but generally speaking, you're a little slow and deliberate. And you know, we've seen this before. I've been talking about technology to advisors for many years now, and I remember when there were, email first came out, and most advisors said, well, I'll never use email with my clients. And I'm sure there's people in the room who remember that time. And the same thing in the web. A lot of advisors at the time when it first came out said, well, I don't need a website. Why would I need a website, right? I'm doing just fine. And now I think it would be difficult to be in business without a website. Same thing with social media. So the point is, whenever there's a new technology, you guys are not the quickest to adopt it, but I think you need to start thinking about these things and adopting a little faster because technology in the world is changing a little faster. We have this tremendous wealth transfer that's in the process of taking place and will accelerate over the next 20 years. I'm sure you've all heard about it, but we're talking about trillions of dollars. And what maybe you haven't thought about is, when your primary contact dies, the money's moving to the spouse and then to the children. And if you don't have a relationship with both, you have a 90+% chance of losing those assets. And if you're using the same tools you used 5 years ago, you're going to lose those assets. Before we talk about robos, I think we need to talk a little bit about demographics. And I think I borrowed this slide from Fidelity. It may be a little bit difficult to read, but if you look at the first column there, emerging affluent, what you see is the demographics are very, very different, right? Most advisors are dealing with the millionaires and the decamillionaires. They're well over 60 years old, much smaller percentage female, and almost totally white Caucasian, and the majority of them are retired. So they're actually in the withdrawal phase. And if you look at the emerging affluent, which if you want to attract them, you're going to need some robo-technology, very different demographic, okay? Much higher percentage female, lower percentage white Caucasian, and they're still in the accumulation phase. So those are the clients you want. So the question is, how are you going to get them? And is your firm today set up to be accepted by them? And I would argue the answer is no. The other thing I think is interesting is Fidelity has a theory about these people. They say most of them are positioned to become millionaires and decamillionaires. Their wealth will exceed the millionaires of today. And a lot of these folks are not using an advisor now, but many of them are open to it. And, you know, the amount of them who are open to seeking advice or who are seeking advice is growing. The other thing, and I think Blaine touched on it, is those are technology natives, all right? So they want a very different kind of experience than your current clients do. And if your firm is not equipped to give them that experience, they're not going to do business with you. And if you want to grow your firm and attract young talent, they don't want BlackBerries. And they don't want to do math on an abacus. The other thing that's interesting about our industry is, you know, we ignored 90% of the population for a long time. And the reason we did was we just could not service them effectively, right? I mean, I talk to advisors all the time. The good ones who have some analytics know that they can't service an account below, you know, X number of dollars AUM unless they have some sort of minimum fee. So they tend just to ignore them. I don't think in the future that that is going to be a profitable way of doing business. So I think we touched on this. I'm not going to belabor the point, but I think new technologies are going to make it much easier for you to spend time and profitably service a much larger portion of the population. And I think that's also where your prospects in the future are going to come from. You know, historically, it's come from referrals. You have people, they don't have a lot of money. When they grow their wealth, they have X amount of dollars, they come to you. Well, what happens if those people are now going to a robo-advisor and they've already got something working? Do you think all of a sudden, magically, when they turn 50 and they hit your minimums, that they're going to come to you? I would argue the answer is no. So let's talk about robos and why you might need them or something like them. So when I talked to advisors even a year ago, or BD execs, they fell into three camps, okay? Those that saw robo-advisors as a threat, those that saw it as an opportunity, and this group, the ostriches. And I think many advisors still fall into that camp, but slowly it's falling away. And there were all these arguments against why we shouldn't care about this technology. And they said, well, these new competitors, they have no AUM, they don't understand our business, their business model's not sustainable, and clients want a personal relationship. Are these arguments valid? Well, some do now have some assets. Firms are in the business that understand the business. Schwab and Vanguard are just a couple of examples. The business model being sustainable, I think it's an open question. The business model that some of them are following may not be sustainable, but I would argue that doesn't really matter because the technology is sustainable, and that's what you should be focusing on. And do clients want a personal relationship? I think yes. At some point, many of them do, but there are some who also want more of a hybrid model with some self-service built in. So the mistake, a lot of the early analysis of these robos was that, you know, they couldn't separate the business model from the technology model. And I would argue it doesn't really care, I don't really care, and you shouldn't really care about the business model that others are pursuing. You should care about the technology and figure out how you can adopt this technology to your business model. Where does it make sense? And I think you can get the best of both worlds. I think you can get much better technology by adopting some of these newer technologies and combine that with your unique expertise and your unique business model and have a winning combination. So what do these new technologies offer that's appealing to millennials, for example? It's a courtship period, right? They don't have to engage with you right away. There's no pressure. There's no prospecting. They can do it at their own pace in a self-service model, and they can engage with you on their terms when they're ready. Obviously, cost is another thing. You know, I don't think in the future that people who call themselves financial advisors, but really all they do is put together a portfolio of mutual funds and charge 100 basis points. I don't think that's a sustainable business model. If that's what you're doing, you better change before it's too late. And then, you know, the question is, do advisors really, in aggregate, provide alpha? I know this is going to make some of you angry, but in aggregate, you don't. But that's what a lot of people emphasize, right? And we emphasize it by charging by AUM and spending a lot of time on investments. And I think most of you in your technology stack and the way you spend money on technology, if you analyze it, the majority of the money you spend is on investment-related activities. But many of you, if I ask you what's your value proposition, the words investment are never going to pop up. So you're really, a lot of the business models now, your value proposition is not in alignment with the way you're acting and with the way you're spending money. Blaine touched on the mobile user experience. I think there's some older clients who are not going to want the mobile experience, and that's fine. But from a cost perspective, from an efficiency standpoint, and from attracting new clients, if you can't offer a great mobile experience, you're going to have trouble. Another thing is gamification. You know, historically, financial planning has not been considered a fun activity by clients, right? Nobody says, oh, I want to go and do a new financial plan with my financial advisor today. Unless there's some, you know, catalyst that makes them do it, they don't want to do it because it's not fun, it's too hard. We've got to make it easier, we've got to make it more engaging, and the newer technologies are showing us how to do that. These newer technologies can service a much wider range of incomes, as I said. You can profitably service sub-$100,000 accounts. So what's the threat to the traditional business? All right? The threat is what I call the death spiral. And that means you have an aging book of business, you have all retirees on your books, you lose the assets when the spouse or the kids take over the money, your pipeline dries up, and a lot of your potential new pipeline, the people who used to find you on the web, or before that through the yellow pages and through referrals, they're now already having a relationship with one of these newer technologies, and it's going to be harder for you to acquire them unless you also have the technology and start the relationship earlier and fill your pipeline through new technologies. So you have to also, I think, rethink your business model, and in Q&A I can tell you how to do that, and that'll help you attract and retain new clients. And I think the most important thing, if there's one takeaway from this presentation, it's business as usual is just not acceptable anymore. So how can you use some of these technologies, right? One way I touched on already is lead generation. You can have some robo-technology built into your website that offers people a free portfolio evaluation, all right? And that gets them to engage, and hopefully, through that, they engage you in a fuller relationship over time, but you've got them in your pipeline. There's this company, Stronghold Financial, was mentioned in Tony Robbins' best-selling book, and what they're using is exactly what I said. They're offering a free portfolio checkup using a robo-advisor, GemStep, that caters specifically to advisors, right? It empowers you to have the technology that a Wealthfront or a Betterment has, for example. They give you a custom website, they give you digital onboarding, account aggregation, you can analyze portfolios for free, and you can integrate it with your current applications if you're working with a custodian that integrates with GemStep, such as TD Ameritrade, to cite one example. And there are a lot of other models out there. Autopilot is 25 basis points all in. It's a combination of Riskalyze, CLS, which is basically creating the ETF overlay and managing the portfolios, and Orion, they use their technology for the digital onboarding and the straight-through processing. And again, all these slides will be available to you, so you don't have to write it down unless you want to. There's been a lot of press lately about Schwab Intelligent Portfolios. It's their robo-advisor. I see the ads on TV all the time now for the retail version. It's very attractive, okay? It's cheap. It's $5,000 minimum, $50,000 minimum. If you're a retail client, you get tax loss harvesting. And, if somebody is looking just for investment advice and they go on there, it's going to be tough, I think, to get them off of there. The institutional one, which just launched the other day, also very cost effective. If you have over 100 million outside the robo with Schwab, it's essentially free. There's no basis points for the technology or for the overlay or for the rebalancing. If you're a smaller advisor, you pay 10 basis points. And it's now available. They just announced the launch earlier this week. It's efficient. It's very low cost. It can be self-service. And I went on there just to try and open an account to see what the experience was like. It's very, very good. It can be custom branded, all the things you would want. I have here, this is the earlier information, 200 ETFs. They actually make over 400. I think it's about 450 ETFs available to advisors, so you can put your intellectual property, build your own portfolios on top of it. And I'm not endorsing Schwab. I'm just giving this as a really good example of the type of technology that's available to advisors today that few, if any of you, I'm guessing, are using. Does anybody here have a robo-advisor type technology that they've implemented yet? Right. Zero. The other thing that's really nice when you're going to any of the custodians who have these technologies is they say it's just another master account. So you can link it to your other technologies that exist in your office. So if you're part of their integration platform and you have CRM through that, portfolio management software through that, what have you, they can all link together and talk to these robos. And there's an advisor console that you can do various things with, including get alerts and change the models if you want. So a lot of people at the beginning were asking, well, if there's a retail version, why would anybody come to you? And I think I just partially answered the question. It's because, first of all, with the advisor-facing platforms, some of them are actually more sophisticated. They allow you to put your intellectual property on top of them, and it allows you to integrate with all of your other software so you can give a hybrid or cyborg experience, which is a combination of real advice from experienced advisors with better technology. And I think this is going to be a game changer, and I think every custodian is going to be offering this. Pershing just announced one. Fidelity did a deal with Betterment. TD Ameritrade is working with a number of robos, and they also have a Amerivest, which is sort of a earlier type of robo-advisor. Everybody's going to have these. I want to turn quickly to big data because I think that's also going to change your life. I'm going to give you just a couple of quick examples, and then we'll leave some time for Q&A. So I don't know if, I'm assuming most of you have heard of IBM Watson, right? It's a supercomputer. You can actually access it online. They're looking to enter the space. They're currently talking with a number of BDs, custodians, and third-party providers of technology to advisors. And I think there's going to be some really interesting implications. One technology that Watson has is it's called the Engagement Advisor, and it powers a self-service model. So you can actually use a supercomputer to service clients, answer their questions, and scale your expertise in a way that's not available to you until now. And again, it can be your intellectual property, so 50 other advisors can be using Watson, but when they use Watson through you, they're only going to get your answers. Discovery Advisor just powers research, so it allows you to synthesize data and explore hypotheses. So for those of you who read these long analyst research reports, if you have a 30-page report, it can synthesize it down to however many pages you say. Say, just give me the highlights and executive summary, it'll give you a 2-page executive summary. It does it all for you. And then if you see something that you're interested in, then maybe you read the whole report. Developer Cloud is probably a little too technical for most of you, so I'm not going to go into it now. But one thing that I think is really interesting that it can do is trade-off analytics. So I do a lot of consulting with advisors, and they say, well, you know, I only have a limited budget, and I have a lot of business problems I need to solve. Which one should I tackle first? That's what trade-off analytics does. It'll help you find the best combination for the dollars you have of the things you should tackle first. And there's all these other ones that are also very interesting, but I'm not going to touch on. Another example of how big data is about to be used in this industry is TD Ameritrade is building big data capabilities for their advisor website. And the whole theory is what they're going to do is if you're a user of their technology, they will track your interactions with their technology stack. And they'll look at the way, the computer will actually look at the way you're doing things and see if you're operating effectively with that technology. And if you're not, it can then serve up suggestions and say, other people in your role who have similar assets under management that you do it this way, and they seem to be doing a much better job of it than you are. Maybe you want to try doing it this way. So that's going to be coming within the next 6 months to a year from TD Ameritrade, and other custodians are also building out this type of technology. So how do you prosper in the future? I think you have to address demographic changes. Business as usual is not going to work. You have to address the client experience. All of the new development in our industry, whether it's Morningstar, the custodians, where are they spending their money? It's all on the user experience. It's the user being you, the advisor experience, and the user being your clients. If you can't offer as good or a better user experience than the best robo-advisors out there today, your business is at risk. You have to be able to communicate on the terms your clients want to communicate. And again, that's going to be different for millennials than it is for your historic client base. It's more about portals, it's more about mobile. We haven't even really touched on the Internet of Things, but basically, everything's becoming connected, and soon, you know, you may be communicating with your clients through their cars, while they're driving to work, on your own private channel, through your own private YouTube channel. There's a lot of ways that we haven't even thought about yet that you're going to be communicating with your clients over the next 3 years that you never have before. If you don't have account aggregation, you don't know all the client assets, where they are, what they're doing, how they're spending their money, what loans they're taking out, you can't service them effectively. And transparency. You know, whether we like it or not, one of the big things that the direct-to-consumer robos are doing is exposing fees and making them very transparent. We have to be able to do the same thing. I don't say we have to compete with them, you know, basis point for basis point on fee, but we do on total value. So it's okay to charge more as long as the client's getting more for it. And I don't think this industry is doing a really good job of differentiating between what they do and what we do and really telling the value prop story. And I think as an industry, if we're going to prosper, we need to do a much better job, and we should be using technology to do that. I think that's all I have. I tried to leave some time for Q&A. Hopefully we can engage you a little bit. Kartik, you want to?
Yep, so first question's over there. Just wait for the microphone.
So you mentioned Watson, and I've kind of heard whispers that Google is trying to make a robo and use their big data and AI. Have you heard anything about that?
Yeah, I mean, I've heard rumors of it too. From what I hear, it's not really the same thing that Watson's trying to do. Watson's really trying to engage more with our community and work with advisors. I haven't heard anything about Google trying to do that yet.
My question's kind of, I guess, simple. I feel after watching or listening to your presentation that we feel so unprepared for what's next.
Yep.
And where do we go to start to analyze our business or integrating the new technology? Just where to begin?
I think that's a great question, and it's not an easy one to answer, but I think the resources are out there. You know, a lot of the custodians are doing a lot of great work on this, and obviously it's in their best interest to help you grow your business. There are independent consultants, both Blane and I do consulting work. I run a technology conference for advisors where there's over 100 vendors, technology vendors. Their only job is to help you grow your business. So I think the resources are out there. It's a matter of really rethinking your business model first, and you say, you know, what do I want to do with this technology, right? I'll give you just a couple of use cases. One is to start like a separate subsidiary that's just targeting the next generation to sort of create a pipeline for the future. Another is to say, hey, maybe I really don't add much value on investing. I want to spend more of my time doing tax planning, estate planning, other higher end value add types of work with my clients, and maybe almost think of these robo platforms as a UMA platform that you can use to very cost effectively manage your client assets and spend time on high value activities. So you have to think about who you want to be, and I think, you know, there's like advisor offices, I go in and no two have the same business model. So just think about how you can incorporate it into what you do best.
And I would remind you that at this event, especially where there's a critical mass of your peers, but also in the exhibit hall, there's a wide, you know, the asset managers and the manufacturers are struggling in a different channel with this same challenge. And if you do business with them or know them, I would engage with them in that conversation. How are you readying your business? You're going to learn a lot from maybe the lessons they've learned in their R&D because there's more capital for them to expend on that.
Yep.
So thanks for the great presentation. Thinking about this issue of advisors needing to compete with robo-advisors to get the attraction of the next generation of investors, I completely agree with you.
Well, thank you.
It's a bit intimidating when you think about these robo companies that raise millions and millions of dollars in venture capital funds and hire entire teams of software developers. How can you speak a bit to how an advisor or an RIA can get started? Like, what are the first steps in ramping up your technology offerings?
Again, I think it's somewhat specific to the firm, but in general terms, if you want to acquire some of the robo-advisor technology, there are firms out there that are B2B firms. GemStep is one of them. I mentioned Autopilot. There's probably a dozen others that don't come to mind immediately, but I can give you a list if you want later on. That are all very happy to do business with you. A couple of them may even be in the exhibit hall upstairs. There's well over a dozen of them. I think we were talking the other day, somebody identified 37 firms that are in the business of helping you compete. So they exist.
Beyond the robo, what other technologies are you talking about?
What other technologies am I talking about? So I think in this day and age, you need effective CRM software. All right, that's a must. And it's not just owning the software, it's having it set up appropriately. You need to automate your workflows. I go into advisor offices all the time. I say, do you have a workflow? And you know, they say, yeah, and I'm like, well, show it to me. It's not in the CRM, all right? So if it's not in the CRM, it doesn't exist. I agree with Blane there. You have to have everything in the CRM. You need document management software. You need to be able to find things. Whether you're using robo technology or not, sending clients paper statements, quarterly reports in paper, even PDFs, you know, is so last century. I mean, that's not what the expectations are today. Consumer expectations have risen. So an earlier speaker at one of the panels said he got 60% of his clients onto digital. And I felt like asking him, what are you doing about the other 40%? Because 60 is not enough. I mean, it's great that he's doing that. He's well ahead of many people. But really, you want to get it close to 100%. You'll never get 100%, but that should be your goal.
Anything else?
Rebalancing technology, obviously portfolio management technology, different mobile technologies, depending again. Well, everybody should have your own branded app, right? Same thing. If you're not on your client's cell phone, you don't exist. I mean, that's where they're going for their financial information. They want to push a button on their phone and interact with whoever is going to give them that information. And if you're not on the phone, they're not coming to you. Yep.
You mentioned there's 30 or more robo firms. So what if you get started with the robo firm and then they fail? You know, it's like, I just have these nightmares about that, like starting with one portfolio management, it fails,
Right.
going with another. How do you vet which are the strongest firms?
So it's a good question. How do you vet the strongest firms? Will all of these firms survive? I don't know. You know, I think it's a question we all deal with, not just with robo-advisors, with CRM software, portfolio management software. There's a lot of acquisitions going on in the industry right now. Some companies are getting taken over. Some companies are not going to survive. You have to do your due diligence. You have to look at their finances. You have to look at their business model. You have to look at who else is using them and make your own evaluation, or you have to rely on other experts. I mean, I do a lot of that type of work. There's other people, I'm sure, at this conference who do that type of work. Probably Morningstar is engaging with some of them and can give you some tips. Your custodians are engaging with them. They have an opinion on it. And then you take all that and you, ultimately, it's your decision. Other questions?
Doesn't USA Today, didn't they come out with a portfolio manager? And Barron's did. It seems like everybody's coming out with a portfolio manager for you to just plug in your numbers and get weekly updates.
Well, I mean, I think there's a lot of people. The question is Barron's and USA Today coming up with these recommendations? I would say perhaps they are, but perhaps they're not in this industry and they're not the most qualified to make a judgment on who's going to survive and not, and who has the best technology, because their expertise, if they have any, is much more on the consumer side than the professional side, and to me, they're two totally different animals.
Question in the back.
So if you adopt a robo-advisor technology for your platform, how do you how do you recommend utilizing it? Do we market it to clients, or do they get the wrong impression that now you have a robo-advisor where you don't want to work with us? So how do you recommend utilizing it once you do decide to adopt it?
It's a great question, and again, I think it depends on the firm and what your goals are. I would say there's some firms that don't want to disintermediate their existing model, and for them, I think one option is to put it and advertise it as a separate level of service, an entry level of service. So in other words, you don't get a whole platform of services. You get our investment advice and maybe X amount of hours a year with an advisor, and this is the fee. If you want a full service model with estate planning, tax planning, a live advisor on call all the time, that's a different level of service, and that's how much that costs. That's just one example.
Would you say that robo-advisors are more vulnerable to cybersecurity threats?
Are they what? More vulnerable?
Yeah.
Vulnerable.
Well, many of them are more aptly funded and capitalized to put the resources in play to defend themselves. That's an advantage they have with the equity raises and the amount of capital that they're raising, and the expectation is that they will put incredible perimeters around the client data because they're taking mass data from the new affluent versus from a small select group. You can imagine the names that Joel threw out: Schwab, Vanguard, TD Ameritrade, Fidelity. Obviously, that security tier that they have now is just going to continue to drip down and apply. I do believe you need to ask that question with the new and emerging companies in the robo space. Doesn't mean that they can't sufficiently defend themselves, but I think you need to be convinced that there's a trust factor there, that they have the right protocols and the right resources in place to defend your data.
I mean, anybody who's doing an integration on the B2B side with the custodians go through a very thorough vetting process, yes. And a lot of that vetting process has to do with security. So you know that at least their experts, the Fidelity experts, the Schwab experts, whoever, have properly vetted it. And they're probably more qualified to do that than anybody in your firm. Does that guarantee anything? No. I mean, you see what's happening. We all read the newspapers. Things happen. But guess what? The clouds that all of this data resides in general, as a rule, is much more secure than anything in any of your offices.
So I have a question while we're waiting for the next question. So advisors have typically tried to differentiate themselves by offering comprehensive financial planning. And that's something the robo-advisors did not have, at least in version 1. Right. Now we're starting to see robo-advisors offer financial planning. Of course, it's not comprehensive and detailed, but we can expect that to come. Mm-hmm. So should advisors be threatened by this financial planning? Is it taking away one capability that they could offer that robo-advisors could not?
Well, I can give you my answer. I don't think so, at least not now, because financial planning is as much an art as a science, and it's more nuanced, and a lot of it is behavioral. And to date, computers are not good at behavioral. So that may change 10 years from now, but I don't think so today. And I think what you're seeing, which is very interesting, among where the acquisitions are happening in the industry and where sort of the broker-dealers are concentrating a lot of their R&D these days, is in financial planning. Like all these firms that never wanted to do financial planning before are starting to do it because they realize that may be the last bastion, if you will, and that's where the value add is. So I think absolutely, if you're in this business, you need to be doing comprehensive financial planning in order to compete in the future. And that's a much better value prop to sell clients than I'm going to beat the market by 25 basis points.
Got a question in the back? Yep.
Yes, with so many options for CRM, portfolio management, financial planning, and rebalancing software, I've found it's really hard to find a good integration. Some of the integrations are a lot more shallow than I would have liked. Do you think one company is going to finally offer a complete suite for the advisor to make it more seamless? And if so, how far are we away from that?
Well, I mean, yes and no, okay? Firms have been trying to do that for a long period of time. Morningstar has a fairly complete suite. Tamarack offers a fairly complete suite. The issue is a lot of advisors don't want to rely on one vendor for everything. And I think I would argue that it's tough to be best in every one of those categories: financial planning, rebalancing, CRM, et cetera. So then the question is, well, is there a platform out there that offers the level of integration you want? And the answer is not yet, but it's getting there pretty rapidly. There's a number of firms, including TD Ameritrade is one, eMoney is another, and there's a few others that are all working on that very diligently. And as I said at the outset, the pace of change is really incredible. Things that used to take 3 or 4 years in this industry to move the dial is now taking 6 months. So it's moving fast.
And one question I had kind of related to that is, many years ago it was just CRM, planning, portfolio management, and research. Now you have trading, rebalancing, risk management, compliance, social media. It seems like advisors are just adding a new product category every year. I mean, are you running, when you consult with your advisor clients, I mean, is that a frustration point that they have to be running 8, 9, 10 different pieces of software, and each new product category has to integrate with all these others, so it's exponentially increasing the integration points, and the point mentioned earlier was a lot of integration points are very loose and not tight, and so.
Well, I'll give you a good example. I just did a consulting job a couple of weeks ago. I was in a firm, and they had rebalancing software, and they were asking me if they should keep it or not. And I said, well, let's put it this way. They don't integrate with any of the market leaders in any other category. To me, that eliminates them, okay? So one of the things you have to look at when you do your due diligence is, how good and deep is their integration with other providers that you're doing business with? And if the answer is not very good or non-existent, I would eliminate them immediately.
Back to the robo-advisor for a minute. I completely agree with everything you said. Our firm
Well,
is
thank
already
you. I like you.
Our firm is already trying to figure out how to use it. I think it's going to be a cost-cutting opportunity personally, but I'm in a bigger institution in a bank, so we have the ability to do things like that. But one of the previous speakers said that most of the money going into the robo platforms is coming out of bank money market type accounts and self-directed accounts. So I have to ask myself, and I'm asking you, could you guess the next major market downturn, that's the money that flocks. I mean, it's gonna leave. If you had to guess, any thoughts on a percentage of money that might just say, whoop, this maybe wasn't for me, I'm gonna get out of the robo? Yeah,
well, when we had the last market dip, somebody gave me a bit of information on that, but I don't know how reliable it is. But they were saying it was noticeable, but not maybe as extreme as one might think, but that wasn't a major market downturn. I think, yes, retail money is not as sticky, obviously. You have the same behavioral issues on a robo-platform that you do in retail mutual funds. I think the robos are trying through technology to address it, but the jury is still out on how successful that's going to be. But again, that's why I think advisors have the upper hand, because to me, investing is as much behavioral as it is, factual. And advisors are the ones that help their clients stay the course. So if you have the best of both worlds, you have the great technology and the guidance of an advisor who helps the client stay the course through the downturn, they're going to be the successful ones.
So I had one quick question, Blaine.
Sure.
So you consult with a lot of advisors on technology issues. So can you provide kind of the characteristics of an advisor who's on the margin, that is an advisor who is most at risk of being affected by the robo-advisor movement, so that kind of as a takeaway, what we can do as an advisor to kind of move away from that margin?
Well, absolutely. I mean, you couldn't imagine letting your clients out of your office without a plan, right? You have to give them a plan and a framework to work with you and to be able to measure progress, challenge issues, and mitigate any risks. And that's the way we interpret working with advisors. And advisors that are most at risk are those that don't have a plan, not just a strategic plan, not just that big, broad vision plan, but the tactical plan. What are we going to do for the next 18 to 24 months to get our business in order and ready? And what are we going to do longer term? How do we look out 3 to 5 years? Not guessing what technology is there. What are we going to look like in 3 to 5 years? If we can do this, if we can change our business model, how do we get to that 5-year plan? So you can't do this without a plan. Whether it's a legal pad and you talk through all these points, or whether it's a very methodical plan that you put together with resources, you have to treat it much like you do a financial plan for your wealthy clients. You have to put together a framework, a roadmap for how you're going to get there, and what the goals are that you would achieve.
Any other questions? We're 5 minutes over, but we can take 1 or 2 more if there are. All right, I don't want to keep you anymore. Thank you very much, Blaine and Joel.
Thanks. Hi.
Charles.
Hi, Charles.
I work for a mutual fund.
Thanks,
server.
Yeah, great.